cash flow from financing activity. So quickly just tell me what all things will come on cash flow from financing activity. Very fast. Okay, and do give me the numbers with the minus or plus. Alright. So if you're taking money out of the vault, you do me minus 5 point or whatever number you're giving me. Or give me total number of cash flow from financing activity. Financing activity. Not operating, not investing, financing activity. Alright, great. So in case of financing activity, I will have 50,000 rupees of interest which I have paid, and I have paid 1 lakh rupees of my loan back. These are the only activities in my year which has something to do with my capital side of the business, which is the sources of the fund side of the business. The investment which I have made is an investing activity, it's not a financing activity. Alright, so 1 lakh rupees of investment is going to be my investing activity. So it's an asset I have created. But as far as the sources of funds are concerned, to repay them, I have repaid one guy 1 lakh rupees, which is my banker, and I have paid 50,000 rupees of interest cost. Alright, so my cash flow from financing activity is going to be minus the number minus 1.5, right? Alright. Now we go to the cash flow from investing activities. Have we done some investments? Well, yes, this year we have done some investments. What are the investments done? I have invested 1 lakh rupees in a mutual fund. Okay, is it a negative number or positive number? It's a negative number. Why it's a negative number? Again, since I'm going to make that investment, I'm going to take the money out of the vault. So I'm going to take the money out of the vault and give it to my broker who will, or my banker who is going to give me the mutual fund units. Alright, so it's a negative activity. Now comes the cash flow from operations. Just calculate the cash flow from operations from the revenue side. If you start from revenue, then you start, and then you will start from PAT and will drag the number. Oh, sorry, from EBITDA and will drag the number. But start from the revenue side first. So it will have 15 lakh rupees of revenue. But did we get 15 lakh rupees of cash? No. We have some receivables also. So it's going to be the same calculation which we did in calculating the balance sheet cash number. Alright. So just calculate the cash flow from operation number and give me the number fastly. Or do one thing, you do the calculations and check if the numbers are matching. The number is going to be 4.3 lakhs. And the formula which you are seeing here is the one which I explained you in the after the first year, which is starting from the EBITDA, okay, and then adding back the changes in the working capital and all that stuff. So just have a look here. Once you get this number, then I'll go and explain all the things which I've mentioned here. Are you able to derive the number? Okay, forget this formula, okay, I'll explain you that part, but are you able to derive the number with the logic? Great, perfect. Alright, now let me give you the bookish formula which generally we use. Alright, so the bookish formula which I explained you last after first year calculations also, it is you start with EBITDA, which is your operating income. Then you add back all the non-cash expenses. So in this case, our non-cash expense is nothing but depreciation. Alright, I'm sorry, you're starting from PAT, not from EBITDA. So when you're starting from your PAT, you add back all the non-cash expenses. Then you add back all the expenses which has nothing to do with your operations. So basically you call it non-operational cash flow activities. And you add back the changes in the working capital. Okay. Earlier, the only working capital change which was happening was the inventory in the first year, which was 0 to 50,000. But in this year, we have change in the inventory also, change in receivable also, because they were last year 0. This year we have some receivables, and we have change in the payables also. Now imagine what is happening here in the balance sheet. If your receivables are changing from one year to another year, that means, let's say your receivables have gone up. What that means is that since your receivable have gone from 0 to let's say 40,000 in this case, 50,000 in this case. So let's say the receivables have gone from 0 to 50,000. That essentially means that you have got 50,000 rupees cash less than what you would have got if you would have sold everything in cash. Not got the cash from people you're supposed to get cash from. So just because you're not getting the number, if receivable is increasing, that means your cash flow number will decrease. Alright, in the PAT you have taken all the revenues which you are going to get. But since you are getting less than that money, you are going to remove that increase in the receivable numbers. Is that clear what I'm saying here? We are not going to add the increases because you are going to subtract it. Nish, you are going to not add the increases in current assets. Okay, since your receivable is increasing, if it is increasing, it is decreasing your cash, total cash number. Alright, so what you're going to do is minus off. Now look at these numbers. This number is telling me how much increase was there made in the inventory. So since the inventory is getting increased, how is it increased? I'm taking the money from the vault and I'm increasing my inventory. So that's a negative. That's going to have a negative impact on my cash flow. This number is also going to be decreasing my cash flow. Why? Because this is a receivable number. So it is going to decrease my cash flow. And this number on the other hand is having a positive impact on my cash flow. Why? Because I can pay off this later. So I'm keeping 80,000 rupees I'm not giving to people which I was supposed to give. Alright, so I'm keeping it with me. So the cash number is actually increasing there. It is going to have a positive impact on it. Alright, so I take the non-cash expenses, which is the depreciation. I take 0.5, which was nothing but my interest expense, which is a non-operating expense. So I add back the non-cash expenses, the non-operating expenses, and I subtract the changes in the working capital. And what the number I get is the cash flow from operating activity. Is the formula clear to everybody? If it's not, we absolutely should. I mean, feel free to ask me. There's no problem. But is the formula clear? What are you doing there? We are starting from the profit number and we are deriving the cash flow from operations by removing off non-operating expenses, non-cash expenses, and changes in the working capital. Yes, absolutely right, Sanjeev. It is 1.1 of depreciation, which is the non-cash expense. So the addition you are seeing of 1.1 is non-cash. The addition at the end of 0.5, which you are seeing, is the addition of non-operating cash. Is this clear? Is this point clear to you? So I'm giving you the formula which you are going to read in various books and everything else. Point 8 is accounts payable. Absolutely right, Ravi. So the formula which you're going to read in the books is when you are going to start from the PAT and you're going to derive the cash flow from operations number. Okay, thank you, Sanjay. So this is essentially the whole idea about deriving the cash flows. Now I will do one thing. I'll take you through an actual P&L statement, balance sheet statement. But if you understand what you have, what I have explained you so far in this particular presentation, you will be able to pick up any profit and loss, balance sheet account, cash flow account, and you'll be able to make sense out of it. But what is happening there? All right. And if you still, are getting some doubts about the flow, you can re-listen to the whole presentation. The audio will be given to you. Okay. So just have a look at some P&L, balance sheet, and all that stuff, and let's make sense out of it. Alright, so this is all you need to know. Now, generally what we do is we start with the definitions and we end up with theory. My intent is not to start with definitions, so I'm going to give you the definitions at the end of my explanation. Alright, so now you read this definition and see if it makes sense to you. Okay, it explains the business financial situation at a particular point in time, and it is disclosed usually every half year. Okay, two parts to a balance sheet: sources of funds and application of funds. Both parts of the balance sheet are always equal. Is this clear? Pretty simple. P&L, the income statement gives an overview of how much was sold, how much cost it makes, how much money was left after the cost was paid. Okay, the income statement generally shows how profitable a company is. Cash flow statement, this is a statement which shows various cash received and various places it has spent the cash on. Okay, so cash enters the company when a customer pays its bill, not when it places an order. So in this case, the company was paying the order, but the revenue will be created, but not the cash. In the same way, the cash leaves the company when a company actually pays its supplier, not when it places the order. So these are the definitions which are given in the book beforehand, but I hope now it is pretty clear to you in the sense that what is exactly happening here. Okay. Now look at a particular company, and I've just taken a small example here. So very quickly, let's go through the P&L account statement. This is Bata's P&L. Okay, so what is happening here? The company is having a revenue of this is in millions, all right? So yeah, so this is 2098 crores. Okay, now this revenue is before the excise duty. So this number effectively will come out. This number effectively will come out to the net revenue number. So the sales number which we saw after paying off the excise duty and everything else, they gave the final number of the net revenue, which is 20,965 millions. Then in your profit and loss statements, which are there in your annual reports, the first three numbers are essentially your cost of goods sold or your total raw material which you have used to make the particular product. All right. So whenever you're looking to annual reports, just add these three items to get the total raw material number. All right. Even in the quarterly statements, you will get these three numbers, which is the cost of raw materials and components consumed, purchase of traded goods, as well as increase and decrease in the inventories of finished goods. So if you combine the three numbers, you're going to get the total raw material cost, which is used to produce the total goods which they have finally come up with. All right. Then you have the employee expenses, and then you have the other expenses. So the very same thing which I explained you in the example, I will take you. So generally, whenever there is a P&L account statement in the annual report, they will also give you the notes to the accounts. The notes to account, the number will be given simultaneously. All right, Pritesh, I'll explain you this thing. Just give me a minute. All right. So as your question, I'm taking a note of. So the notes to account will give you the explanation of each and every item. So I'll show you some notes also. But this is the basic outline of a P&L statement which we just discussed. Okay. So there are other expenses. There is depreciation, and you have finance costs, which is nothing but the interest costs. You have some kind of exceptional items. Generally, company, they give exceptional items when they believe that this item is not going to be repeated in future. All right. So this is an exceptional item. I'll show you this item also in this presentation. So this is a normal P&L statement which looks like, and it ends here, profit for the year. After this is the revenue number which is shown here. All right. Sanjeev, I got your question. I'll just explain you. Just give me a second. All right. Let me just take you through. So the revenues here is, this is the number which is shown here in the revenues. Now this is how the notes look like. So whenever you click on the notes and you go to the notes, you will get this, which is the detailed explanation of what exactly is coming in that number which the company is giving you. All right. So the company gives you the complete breakups. In some cases, the breakup is far more detailed. In this case, they have given you the details of which all products they have sold. They have sold 19,847 worth of footwears and few things coming in others. Okay. And here, if you see, the other operating revenue is also included in the sales number. Some company gives you this number separately. Some company includes this in the revenues and gives you. So you should be. Why I'm telling you all these things is because when you're making comparison of two companies, you should know what all things are included in the total revenue numbers. And since every company is a discretion of telling you what, I mean, they have a discretion of taking it wherever they want to show, you should be going to the notes and doing the comparison rather than just taking the outline numbers which are mentioned in the various sources. So you will have various sources which are like you can look at Money Control, Screener, and all these sites. Generally, they give you the headline numbers, but if you don't know the detailed numbers, comparison will become pretty difficult. You can have a broad view from there, but not a detailed analysis from there. Okay, now let me take the question which you guys were asking as to what exactly these numbers tell you, right? Increase or decrease in the inventory of finished goods. Okay, Now it is the inventory increase and decrease of not of the raw material inventory. Okay, so in our example, what we are doing, we are getting the raw material, we are storing the raw material in the storeroom. But if you have some fixed, so in our case, let's assume that you made an ice cream this year, okay, but you're not able to sell it, so you store it in your storage, and then next year you sell that item. All right. Now when you sell it, you're not using any raw material to make that ice cream, but you're still selling it, so it will come in your revenues. All right. So that change in the inventory of finished goods is also going to be a part of your raw material cost. Are you getting what I'm saying here, Sanjeev? What number is coming here? Yeah, great. Any other doubts there? That was the only doubt which came, right? Pritesh, I think you had the same doubt, if I'm not wrong, right? All right, great. So let's move forward. Okay, this is the other income. Now, generally, companies give other income below the EBIT number for a simple reason. This is not really the income which they are going to derive from their actual operations. All right. So if the company has deposited some money in a bank and they're giving them interest, that is not going to be a part of your operating income. Because again, be it a shoe company or an oil company, it doesn't matter. The kind of income is going to be pretty much same. Now imagine this, let's say if you have a hospital or something, okay, and you have some land which is there outside your hospital, and you gave it to, let's say, an ATM, a bank for the ATM, and you get some rentals there. So the rental income again is not a part of your main core activity of a hospital, okay. So that also is going to come under your other income and not in other operating income. There is a slight difference. Till a point, I think till 2012 or 13 if I'm not wrong, other operating income and other income were combined together and they were given as a one number. Okay, but only after recent changes they have started, I mean it's clearly mentioned that you have to give other income separately than other operating income. Alright, so let's move forward. These are the total expenses, we have discussed this. Now I want to show you the notes to the account. So this I have told you, if you combine these three items, you're going to get the total raw material consumed. This is how the employee benefit expenses is shown. We have discussed all this. See, this is what the other expenses are. Okay, so all the expenses which are not in those two heads are now combined to give you the other expenses. Okay, so from legal cost to sales cost, advertising, promotion. Now every company has a different way of representing these things. Most of the FMCG companies give you the advertising numbers and the distribution cost number separately and not in other expenses. Why? Because that is one major expense they have in their own operations. So again, depending on which particular type of company you're studying, you will have different kind of representations from various companies. Okay, finance cost will give you all the costs which are related to financing of the loans, the loan component. Now there is a slight amount of, there's one exception to this number which I'm going to mention here. Some companies generally do something called bill discounting. Okay, so what they do is they sell off their debtors to some party who takes the responsibility of getting money from their debtors. And whatever cost they incur in doing this, they mention it under the finance cost. But actually it is not a cost which they are bearing on their loans. Okay, so whenever you see finance cost, do a small favor, just go to the notes of accounts and see whether it only includes interest cost or it also includes a lot of bill discounting and all this stuff. If they are using bill discounting, just remove that number to calculate your actual interest cost. Okay, just for the sake of your understanding, just go home and look at Bajaj Electrical's P&L, you will get what I'm saying. So this is the exceptional item which I told you. They generally the exceptional items are something which they don't believe are going to recur every time. But in a lot of companies they do this thing. Every quarter there will be an exceptional item. Now technically, if that is happening, it should not be an exceptional item. It should something be a part of your normal regular P&L statement, but that is not the case. Okay. In the P&L, you will see these three heads combined will give you the total tax expense. Okay, and this is the final profit number which is right, 1907.43. Now this is the number which is going to go and add to the owner's earning number, which is the owner's profit, the owner's money, shareholders' equity, whatever you want to call it. Okay, so in the balance sheet number, in your reserves and surpluses, forget the classification as of now. I'll tell you this thing later. There was some question in the starting on this also. But in this total shareholders' funds or owner's money, this 1907 is going to get added, and that is going to be something of this sort. I'm sorry, the circle has gone slightly haywire, but this is the number, profit for the year 1907, which is going to be added this year to your total shareholders' wealth. These are the liabilities. So I've just given you the snapshots here so that you can very fastly see and relate to whatever we have studied so far. Okay, and this is the final cash flow from operating activity. Is the number we commonly use. Financing from investing activities, see, this is the purchase of the fixed assets and sale of the fixed assets or investments which are done in the bank deposits. So interest received is a part of your investing activity because you have made some investment on which you're getting the interest. All right. Imagine this thing: if you give a loan to somebody, all right, that is also going to be, you're going to receive some interest in that. Is that a financing activity? No, it is again an investing activity, right? So be sure of the classification difference whenever you see the same kind of heads coming to different cash flow activities. Then you have this cash flow from financing activities. There's this interest paid, the dividends paid, the tax paid on the dividends. Yeah, so that's it from my end. Now if you have any questions, I will take you from this, but this is the basic idea. What I wanted to cover in this this webinar was to take you through the briefs of financial statements. I hope now if you go and just listen to it again and just see any kind of financial statement, you will be able to cover it well. Okay. Now I'll do one thing. I'll put this video online for you in the YouTube channel. As of now, I just created it today morning only. I don't have a YouTube channel, but I was just thinking of putting all these videos on the YouTube so that you can, whenever you want, you can just go and have it. And I'll put this presentation on my website, and you can just download the presentation from there for your own understanding. Okay, so that's it from my end. I think Nuresh is also there online, so he'll take it from here, or we can just have a question answer round. Whatever questions are there in your mind, we can just have a discussion. Okay, Pritesh, you have asked something on the intangible assets part. Let me just go down and see if you mentioned more. Seven common areas where company makes fraud. Well, there are a lot and lot of things. What I'll do is just hold on, just hold on. Yeah, what I will do is I am actually planning another session which is on financial shenanigans only. Okay, so I will talk about a lot of fraud which company generally does. So as and when that session is planned, I'll explain you that. Okay, so I mean it's a very very big area. It's not a small area to discuss on where the companies make fraud.